Okay, so you want to own a liquor store, stock the shelves with beer, wine, and spirits, and sell a product that people buy in good times and bad times alike. Recession-proof demand in a business generating over $80 billion a year in the United States. No complicated supply chain, no seasonal collapse, just steady, dependable margins on something people are going to keep buying regardless of what the economy's doing. That is the dream, and it is not entirely wrong. Here's what it doesn't tell you. In some states, the single most valuable asset you own isn't your inventory or your building. It's a small piece of government paper that a single legislative vote can turn from a six-figure retirement fund into a $10,000 formality overnight. Let's start with what it costs to open one. Most estimates put total startup costs at $100,000 to $250,000 for a typical independent store, though a serious build-out with prime real estate can push that to $500,000 or more. Real estate runs roughly $100 per square foot to build out, or around $24 per square foot annually if you're leasing in a shopping center. Initial inventory alone runs $20,000 to $250,000, depending on how deep you stock your beer, wine, and spirits sections, with a balanced opening wine selection alone typically requiring $8,000 to $25,000, and a comparable beer build-out costing about the same. Add store design, point-of-sale technology, and initial marketing, and a well-capitalized independent store commonly lands in the $200,000 to $600,000 range before the doors open. Then there's the license, and this is where the business stops looking like normal retail. In an open license state like South Dakota, a liquor license might cost as little as $300. In California, a full liquor license can run as high as $375,000. And in quota states, states that cap the total number of liquor licenses ever issued, the math becomes something else entirely. New Mexico limited itself to just 407 full liquor licenses statewide for decades. And because that number never grew while the population and the economy did, licenses became a scarce, tradable asset in their own right, some changing hands for over $1 million, with the average sitting around $318,000 just before a major 2021 reform. That price isn't paid to the state. It's paid entirely to whoever currently holds one of the finite licenses, meaning the real barrier to entry in a quota state isn't your business plan. It's finding someone willing to sell you their government-granted scarcity for a 6- or 7-figure check. Here's the trap sitting underneath the entire business in quota states, and it's the one that almost nobody explains to a new buyer. If your license is worth $300,000 or more, many owners quite reasonably use that value as collateral for their business loan, the same way you'd use home equity. Your license isn't just a permit. It's sitting on your balance sheet as one of your largest assets, which means your entire business's financial stability can depend on a piece of paper whose value was never set by supply and demand for alcohol, but purely by an arbitrary legislative cap that can, in theory, be changed by any future session of the state legislature. Once you're open and licensed, the day-to-day economics are genuinely solid. Gross margins run 20 to 30% across the store, with wine specifically running 15 to 30% and attracting a loyal, higher-spending customer base. A well-located store can generate $500,000 to $2 million in annual revenue. Beer, particularly the fast-growing ready-to-drink cocktail category, has kept pulling in double-digit revenue growth, even as overall beverage alcohol volumes softened slightly in 2025. The core layers of revenue are straightforward: beer for volume and foot traffic, wine for margin and loyalty, and spirits for the highest ticket sizes, with most owners deliberately building a balanced mix across all three so no single category slowdown sinks the whole store. Now the disaster case study. And it's not a single bankrupt liquor store. It's an entire class of asset losing much of its value in a single legislative session. For decades, New Mexico's quota system had turned a capped supply of 407 liquor licenses into one of the state's strangest financial instruments, with individual licenses trading for $150,000 to over $400,000, and existing holders using that paper value as loan collateral, retirement savings, and inheritance for their families. In 2021, facing pressure to modernize an alcohol licensing system critics called archaic, and after a widely publicized drunk driving tragedy at a parade added urgency to the debate, the state legislature passed sweeping reform. Restaurants could now obtain a license to serve spirits for as little as $1,550 to $10,000 a year, a fraction of what existing quota holders had paid. License holders warned lawmakers directly that the change would devalue their asset and, in some cases, push them into loan default, since many had structured business financing around the license's appraised value as collateral. One bar and liquor store owner testified that if his license's value collapsed, his debt-to-worth ratio would climb from a manageable 3-to-1 to 7.5, potentially triggering default on his existing loan. The legislature passed the reform anyway. Within roughly a year, the average price for those once scarce licenses had fallen from about $318,000 to closer to $275,000, and further declines continued as brokers, anticipating a permanently changed market, began underselling licenses rather than waiting for buyers willing to pay the old quota-era prices. Nothing about any individual liquor store's operations changed. The shelves were still stocked, the customers still came in, the margins on the actual product were exactly the same as the week before. But the single largest line item on many owners' personal balance sheets, the license itself, lost a meaningful share of its value the moment a legislature decided that scarcity had outlived its usefulness. Let's run the numbers on two scenarios. Optimistic case, you open a well-located store in an open license state where the license itself costs a few hundred to a few $1,000s, putting your full $250,000 startup budget toward inventory, location, and build-out instead of an artificially scarce permit. At $1 million in annual revenue with a 25% gross margin, you're generating $250,000 in gross profit. And after rent, staffing, and operating costs of roughly $150,000, you clear a genuine $100,000 a year, a solid, durable small business return with no legislative risk sitting on your balance sheet. Realistic case, you open in a quota state, paying $300,000 of your startup capital for the license itself, financed partly through a loan that uses the license's appraised value as collateral, exactly the structure New Mexico's owners described. Your store performs identically to the optimistic scenario in terms of day-to-day revenue and margin. But a future legislative session, responding to consumer complaints about artificial scarcity or a push to expand restaurant alcohol access, reforms the licensing system, and your license's resale value falls by 15 to 30% almost overnight, exactly what happened in New Mexico. Your collateral shrinks, your loan terms tighten or trigger a review, and an asset you were counting on as part of your eventual retirement or exit plan is suddenly worth a fraction of what you paid for it, entirely independent of how well you actually ran the store. So if you decide to own a liquor store, understand what you're actually buying. In most of the country, you're buying a straightforward, durable small retail business with genuinely recession-resistant demand and healthy margins. But in a quota state, you're also buying a second, much riskier asset stacked on top of the first, a government-granted scarcity that has real dollar value right up until the moment a legislature decides it shouldn't. Run the store well, and either version of this business can support a family for decades.
Just make sure you know which version you're actually holding before you use it as collateral for anything else.